Here's a question that's going to expose something shocking about wealth building. If you start with $50,000 today, which investment gets you to $100,000 faster? Rental property or index funds? Everyone assumes it's real estate because of leverage. You put down $50,000, you control a $200,000 asset, boom, you're building wealth faster. Wrong. And I'm about to show you data that's going to make real estate investors very uncomfortable. Because when you track the actual speed of wealth building, accounting for all the real costs and time, the results are shocking. I tracked 2 investors over 5 years. Both started with $50,000 in 2019. One bought a rental property. One bought index funds. And the race to build wealth wasn't even close. But not in the direction you think. I'm going to show you month by month what happened to their wealth. The exact point where one pulled ahead. And why leverage is actually slowing down wealth building. By the end of this video, you'll know which investment actually builds wealth faster, and which one gets you to financial freedom years earlier. Here's what most people believe. Real estate builds wealth faster because of leverage. You put $50,000 down on a $200,000 property. Property appreciates 5% yearly. That's $10,000 in appreciation on your $50,000 down payment. That's a 20% return on your invested capital. Sounds amazing. Leverage is magic, right? Meanwhile, index funds return maybe 10% per year. So $50,000 becomes $55,000. Real estate made $10,000 in equity, index funds made $5,000. Real estate wins, right? This is the story real estate gurus sell. And it sounds logical. But it's missing so many hidden factors that when you account for them, the narrative collapses. Let me show you what actually happens when you track wealth building speed with 2 real people starting in January 2019. Pay close attention. Meet Marcus. He's 32, makes $75,000 per year, and saved $50,000. He wants to build wealth as fast as possible. He reads that real estate leverage is key. He finds a rental property for $200,000. Puts down $50,000. Gets a mortgage for $150,000 at 4.5% interest. After closing costs and repairs, he spends $54,000 total. He rents it for $1,700 per month. His mortgage is $760. Property taxes $280. Insurance $110. Maintenance budget $200. Total expenses $1,350 monthly. Cash flow $350 monthly. Meet Lisa. Same age, same income, same $50,000 saved. She invests it all in a Vanguard S&P 500 index fund. She sets up automatic $300 monthly contributions. Then she forgets about it. Now here's the critical question: who builds wealth faster? Let's track them month by month for 5 years from 2019 to 2024. Month 1, January 2019. Marcus has $50,000 down on a $200,000 property. His equity is exactly $50,000. He owns 25% of a $200,000 asset. His wealth, $50,000. Lisa invested $50,000 in index funds. Her wealth, $50,000. They're tied at the starting line. Same amount. Same month. The race to build wealth begins now. Month 6, June 2019. Marcus collected $350 per month in cash flow for 6 months. That's $2,100. His mortgage is down $800. His equity is now $52,900. Plus he has $2,100 in cash. Total wealth, $55,000. Lisa's $50,000 grew at about 10% annualized for 6 months, plus she contributed $300 monthly. Her account is $55,300. She's ahead by $300. Wait, Lisa is ahead already? But Marcus has leverage. He's using the bank's money. How is she ahead? Let's keep going. Month 12, December 2019. Marcus's property appreciated 4% in the first year. It's now worth $208,000. His mortgage is down to $148,400. His equity is $59,600 total. He collected $4,200 in cash flow for the year. But he had to spend $1,800 on unexpected repairs. His net, $2,400 cash. Total wealth, $62,000 after 1 year. Lisa's index funds had an exceptional 2019, up about 31%. Her $50,000 plus $3,600 in contributions became $70,100. She's ahead by $8,100 after just 1 year. But real estate investors will say, wait, 2019 was an exceptional stock market year. That's not fair. Okay, let's keep tracking through 2020 when the market crashed. March 2020, the COVID crash hits. Lisa's index funds dropped 34% in 3 weeks. Her account goes from $73,000 to $48,000. She just lost $25,000 in 3 weeks. She's now behind where she started. Marcus's rental property doesn't change value in 3 weeks. It's still worth about $210,000. His equity is $62,000. He's ahead now. Real estate wins during crashes, right? But here's what happens next. Lisa keeps her automatic $300 monthly investments going. She's buying index funds at 30% discount during crash. Marcus's tenant loses their job and can't pay rent. Marcus has 2 months of vacancy. No rent coming in, but he still has to pay mortgage, taxes, insurance. That's $1,150 per month out of pocket for 2 months. He spends $2,300 during vacancy. This is the hidden cost of real estate nobody talks about. By December 2020, the market has fully recovered. Lisa's account is worth $102,000. Her $50,000 investment plus consistent contributions through the crash paid off massively. She doubled her money. Marcus's property is worth $218,000. His mortgage is $145,000. Equity, $73,000. But he lost $2,300 during vacancy and spent $3,500 on turnover costs getting new tenant in. His cash flow for the year after expenses, -$900. Total wealth, $72,100. Lisa is ahead by $29,900. And it's about to get even wider. Watch this. 2021 and 2022, the real estate and stock markets both boom. Marcus's property appreciates to $270,000 by end of 2022. His mortgage is down to $138,000. Equity, $132,000. Cash flow collected over 2 years, $8,400. Total wealth, $140,400. Lisa's index funds grow to $168,000 by end of 2022. She's ahead by $27,600. But then 2022 hits hard. Stocks drop 18% in 2022. By January 2023, Lisa's account dropped to $138,000. Marcus's property held value at $270,000 with $135,000 mortgage. Equity, $135,000. They're nearly tied again. But here's the critical factor everyone misses. Liquidity and opportunity cost. Lisa can access her money in 24 hours. Marcus's wealth is locked in a house he can't touch. He can't touch it without selling or getting a hellick with fees and interest. His wealth is trapped. By December 2024, 5 years in, here's where they ended. Marcus's property appreciated to $295,000. Mortgage down to $129,000. Equity, $166,000. Total cash flow collected after all expenses, $12,800. Total wealth, $178,800 after 5 years of work. Lisa's index funds are worth $247,000. She's ahead by $68,200 after 5 years. But we're still not accounting for the hidden factors that make the gap even wider. Marcus spent approximately 8 hours per month managing the property over 5 years. That's 480 hours. At $30 per hour opportunity cost, that's $14,400 in time value lost. Marcus had a major HVAC repair for $7,200 not covered by his maintenance budget. Adjust for these, and his real wealth is $157,200. Much less than it appeared. Lisa spent 0 hours managing her investments. 0 unexpected costs. 0 stress. 0 tenant calls. Her wealth, $247,000. She built wealth $89,800 faster than Marcus over 5 years. But here's what really matters: the velocity of wealth building. Let's look at when each person hit key milestones. This reveals the true speed difference. To reach $100,000 in wealth, Lisa hit it in month 31, about 2.5 years in. Marcus hit it in month 38, about 3 years in. Lisa was 6 months faster. To reach $150,000 in wealth, Lisa hit it in month 48, exactly 4 years. Marcus hit it in month 54, 4.5 years. Lisa was 6 months faster again at every milestone. The pattern is clear. Index funds build wealth faster than rental property when you account for all real costs, time investment, and liquidity. The data doesn't lie. But real estate investors will argue, what about tax benefits? Depreciation? Mortgage interest deduction? Fair point. Let's account for those tax advantages now. Here's the adjustment. Marcus can deduct mortgage interest and depreciation. That saves him about $3,500 per year in taxes. Over 5 years, that's $17,500 in tax savings he wouldn't have otherwise. Add that to his $157,200 wealth, and he's at $174,700. Lisa still has $247,000. She's still $72,300 ahead even after accounting for all his tax benefits. And Lisa has tax advantages too. Her index funds grow tax-deferred. She hasn't paid capital gains tax yet. When she does, it's long-term capital gains at 15% rate. Not ordinary income rates. So why do people think real estate builds wealth faster? 3 reasons that nobody talks about. Let me expose them right now. First, confirmation bias. People who succeed in real estate talk about it constantly. People who fail quietly sell and move on. You only hear the success stories online. Second, the leverage myth. Leverage amplifies gains, but it also amplifies costs. Mortgage interest, property taxes, insurance, maintenance all scale with the property value. Leverage isn't free. Third, forced savings. With rental property, you're forced to pay the mortgage every month. That builds equity through discipline. But index fund investors can create the same forced savings with automatic investments. Here's the bottom line. If you want to build wealth faster, index funds win for most people. Lower costs, 0 time investment, complete liquidity. And historically higher returns after accounting for all factors. But rental property can work if you have specific advantages. You can buy significantly below market value somehow. You can manage property yourself and value your time at 0. You're in a market with high rent-to-price ratios. You have unique skills or connections in real estate. For the average person with a full-time job, index funds build wealth faster. By the time you account for time, unexpected costs, vacancy, and illiquidity, rental property is slower. If you're choosing between these two, here's my advice. Start with index funds. Build $100,000 to $200,000 there first. Then add rental property if you want diversification later. Don't make rental property your first investment. It's slower, more complex, and less liquid. Build your foundation with index funds, then layer in real estate if it fits. If you found this valuable, subscribe because I compare investment strategies with real data over real time periods. Not theory. Not guesses. Real tracked results over years. I've created a free wealth building speed calculator comparing rental property versus index funds. You plug in your numbers, it shows you projected outcomes based on historical data. Link in the description. Drop a comment. Are you surprised index funds built wealth faster? What's your experience with rental property versus index funds? I want to hear. Remember, building wealth fast isn't about leverage. It's about consistent returns, low costs, and staying invested through volatility. For most people, that's index funds winning every time. Thanks for watching, and I'll see you in the next video where I compare more investment strategies with real data.